believe everybody should be able to see my screen now. Is that correct?
Yep.
All right. That is a beautiful thing. You know, it actually worked out in our favor this time. So look, listen, everybody, I appreciate you guys taking the time. I mean, I think today's going to be a good day. We're going to try and breeze through, some of the things that we want to talk about fairly quickly, and then we'll certainly make time to pause and answer any questions. I'm sure from time to time there's going to be individuals coming into the presentation, and certainly. All right, let me share this screen. Desktop 2, and. I believe everybody should be able to see my screen now. Is that correct?
Yep.
All right. That is a beautiful thing. You know, it actually worked out in our favor this time. So look, listen, everybody, I appreciate you guys taking the time. I mean, I think today's going to be a good day. We're going to try and breeze through, some of the things that we want to talk about fairly quickly, and then we'll certainly make time to pause and answer any questions. I'm sure from time to time there's going to be individuals coming into the presentation, and certainly I want to make both Lou and I available to address them as they pop in. But look, we're excited. We're here to talk about the Beacon Wealth LPL Research halftime mid-year outlook. We've updated our views for the pillars of investing, the economy, bonds, and stocks. And listen, there is no mistaking about it. Headlines are changing daily, right? But we look to these pillars, as mile markers, as trail markers, and we look to this mid-year outlook to help provide some perspective on how we're going to face these challenges that are ahead of us now and moving forward, and we're going to do so together. I always like to use the analogy, when we talk about mile markers, I don't know what mile marker we're going to crash our car, right? But I do know what conditions favor an accident over good conditions. So this is what this mid-year outlook is really all about. Look, we're very mindful that it's been an extremely challenging year so far in the U.S. and around the globe. And as everybody knows, we're in the midst of a pandemic that continues to impact us all of our communities and all of our economies. But look, together, we're gonna find new ways to face the challenges, how we can prepare now for better times. And thus far, we've been impressed with what we've seen, the resiliency, and the accelerated innovation amongst large and small U.S. communities, and then most of all, the dedication of our frontline professionals, medical researchers, and everyone every day helping us guide us through this health crisis. So we're going to talk about the trail to recovery. We're going to analyze the economy. We're going to talk about stocks. We're going to talk about bonds. And then my favorite, we're going to talk about the election coming up in 2020. These are all things that, that we have ahead of us. Lou DaCosta and I will flip back and forth. Obviously, for anyone that may not have met me, you see my name obviously in the title. I'm Anthony Calabrese. I'm one of Lou's partners. Lou's also there for anyone that may not have met him. But we're going to flip back and forth. Listen, and we will pause after each section to answer any questions. And as I said, there should be some additional members popping onto the presentation. We'll try and we'll try and pause for them as well if need be. But as we move along, let's take a quick step and let's talk about the economy. Okay, the stock market, right, and the bond market together. Well, much of real-time economic data that we follow revolves around transportation activity, home sales, and jobless claims, right? These are all showing tangible economic activity. Now, while still very depressed, all three of these items are making a very big comeback, okay? That's important. That is very important because all three of those items lead to future economic activity, okay? Listen, the U.S., as we know, statistically entered into a recession in March of 2020, based on the National Bureau of Economic Research. We know it was as a result of lockdown, so it was a governmentally imposed recession, okay? GDP contracted by 5% in the first quarter. Our estimates said that GDP was going to contract by 34.5 in the second quarter. We were pretty darn close. The exact number was 32.9, right? So by definition, we're there. We're in a recession, okay? We tend to believe, and based on our projections, that the second half of this year is actually going to be very strong. And it will make this recession the shortest ever on record. Having said that, while we do think the second half of this year will be strong, we don't think the resulting recovery will be strong enough to get economic activity back to 2019 levels by the end of this year. We expect that to occur sometime in 2021. The trajectory of the economic rebound certainly remains uncertain. You hear us talk about it all the time. Is it going to be a V recovery? Is it going to be a W? Is it going to be a Nike swoosh? Is it going to be, a square root symbol? What is the recovery going to look like? Okay, we believe it's going to be multi-stage recovery, right? We believe that we already saw that there was a sizable contraction in 2020, as you see right here, right? And then we think that second half of the year growth, the headwinds may linger well into 2021. So our stance and our base case is that we're going to be looking at more like a Nike swoosh type recovery. All right, if you could call it more or less a check mark or a square root symbol, right? Because we have a sharp pullback, we have a strong recovery, and then we have a gradual increase moving forward there. So more like a Nike swoosh symbol. We don't believe the V is really is something that is sustainable, and we don't think the U shape really captures the multi stages of recovery. More importantly, and the reason why we feel this way is that we don't actually see, despite all the, the rapid, medical developments and the push for a vaccine, we don't see a really solid, widely available vaccine until 2021. Okay. That being said, certain things can change, and as I said, we're the data changes almost on a daily basis. Now, look, those are the big things that we think are that we're looking at that are ahead of us, right? I want to pause for a moment and just see if anybody has any quick questions in regards to where we think the economy is going to look like, or what we think the economy is going to look like coming into recovery for the second half of the year. No questions. Moving right along. Well, look, Lou, I'm going to pass it over to you. And I want you to talk a little bit about the stock market and what we expect to see moving forward for the next 5 months.
Sure. So we have a little bit of an easy crowd here today, so nice and easy. All right. So listen. So turning to the market, we've seen stock prices already going up. Okay. We're assuming we're going to receive, some breakthrough treatments, to end the pandemic. However, with the optimism we see reflected in the S&P 500, the gains may be limited, and that's just basically because we saw a lot of the gains come in already for the year. So as though we're still expecting a good recovery, a strong recovery. Gains as far as the market goes, we don't expect them to be as high just because we've already seen the gains already came in because the stock market is forward looking. Okay, and can you change the slide for me? All right. Okay. So Our expectations for a gradual economic recovery in the second half of 2020, they appear to be in conflict with the rapid ascent over the past 12 weeks with the S&P 500. On one hand, gains appear to be appropriate based on the likelihood that this may be the shortest recession ever, which is also aided by massive stimulus and progress towards a vaccine. On the other hand, a second wave still remains, unseen. We don't know if it's going to happen or not. And, we also have the issue with the 20 million jobs lost in March and April. And that's, again, hopefully coming back. But again, due to social distancing restraints and the potential for changes in consumer behaviors, we just, we don't know how consumers have changed over the last few months if they're willing to do certain things that they did in the past. Okay. And the other thing is, stocks have come up very fast and too fast. Okay. And what the chart is really showing here, we've had years like 1980 to 1990 where the months to recovery, in 3-4 months, we're back to the same levels. But generally, the declines have been a lot steeper, which means they've taken a lot longer to come back. Okay. Yeah, can you change the slide for me?
I think I had jumped ahead one ahead of you by accident. Sorry about that.
All right. So S&P 500 total forecast. Okay. So we forecast the earnings to be between 120 to 125 per share. Current level right now is at 115. So based on this, at the midpoint, we're looking at about a 25% drop from 2019, which is actually roughly in line with the historical declines. Okay, and so the chart is, it's reflecting a couple things. It's the severity of the decline in the economic activity for March and April. It includes the initial snapback in activity with the states actually reopening, and the growth headwinds that will constrain the trajectory of the recovery later this year. Okay, next slide, Ant. All right. Okay. So we believe, we're actually optimistic with the economy recovery, with the base case. So we assume like the S&P 500 will be around that 3,250 to 3,300 range. Okay. Currently, it's already at the higher end of the spectrum here. Okay. Well, we think with the annual earnings, the run rate on that stuff, it's not going to be really achievable until 2021. Okay, but with interest rates being low, the possibility of a vaccine, things may change over time. Okay, Anthony, I'm going to push that back to you now, unless anybody has any questions.
Yeah. So look, if anybody has any questions, I know we ran through that quickly. To sum it up, the bottom line, look. The stock market, as Lou had mentioned before, is very forward looking, right? So, and the easy way to understand this is like, you think about March 23rd, March 24th, right? Everyone really kind of felt like the world was ending. Nobody thought that, that we would be where we were today on March 23rd and March 24th. Had, everyone, the lockdowns literally just started a week before, right? And people didn't really and we didn't even have unemployment numbers at that point. But that was the bottom of the market, right? That was the peak, that was the trough of the market. From that point forward, stocks started rebounding and started increasing. And you may ask yourself, well, why is that, right? Well, that doesn't make sense. 30 million people now that we know now are unemployed, and companies were shut down, and nobody was doing business, and the only one that was having success was the liquor store, right? So why would the stock market start rebounding at that point? As he said, it's because they're forward looking. The stock market's price in the future potential of what the economy will look like, not the present day picture. Okay, so look, something that's even more forward looking than stocks is actually the bond market. So let's turn to the bond market. But before I do that, Wanted to see if anybody had any questions in regards to anything that Lou just touched on right now. Nope. Okay. All right.
Got an easy crowd today.
Yeah, very easy crowd. We'll keep it moving. We'll be wrapped up by 5 o'clock, I guess. Who knows? Unless we give them the test that we had planned for them. But I don't know. Maybe we'll let them slide a little bit easy. We'll see. It's multiple choice, and just make sure you answer C. So listen, look, many of you might have refinanced in the past month, maybe month and a half. I'm actually doing it right now. My mortgage rate is 2.875. Right now, I'm going to be refinancing. It's unheard of. No, I don't care whether you're 20 years old. I don't care whether you're 60 years old. You haven't seen interest rates that low in your lifetime. And quite frankly, we don't know that we'll ever see interest rates that low ever again. So we are at, without question, historically low levels. Our feeling is that we will remain at historically low levels moving forward for the balance of 2020. Having said that, we will trend higher, okay? We expect the 10-year U.S. Treasury yield, which is really the barometer of all bonds and all interest rates, to finish somewhere between 1 and 1.5% for the year. Right now, we stand just right at 1%. So we do tend to think we're going to trend higher, but we don't think we're going to be. And we don't listen. We don't claim to be rocket scientists. We don't claim to be geniuses. The Fed is telling us they don't expect to raise rates. So the reality of it is, rates aren't going to, they're not going to go anywhere that fast. We do, however, expect them to trend higher over time. So what does that mean for the bond market? Well, if you understand the relationship between yields and bond prices, they're inverse. It's very simple. As rates increase, prices fall. As rates decrease, prices rise, right? So, if we expect rates to increase, albeit in a small trading range, we would expect bonds to underperform for the second half of the year. We may even see some loss of, some risk of principal and some loss of principal within the bond market. Not all sectors of the bond market, but in the general sense, the Barclays aggregate bond. Despite that, however, we do not think any losses that could be, that we could see, or any potential for losses over the course of the next 5 months will erode any of the profit or any of the gains that bonds have seen for the first half of the year, right? U.S. Treasury bonds, obviously, were a pretty solidly performing instrument from for the first half of the year for the most part. So any risk of loss, any risk of principal, we don't expect that to erase any of erase any of those gains. Excuse me. But we do expect an increase in rates within a small trading range. Okay, and like I had said, really to sum it all up, I'm not the only one in this camp. Less than 50% of economists will say that the Fed isn't going to do anything with rates throughout the course of 2020, maybe not even for 2021. As far as the Fed puts it, they're on hold until economic data warrants us to no longer be on hold. And they, and they said that could be until 2022. So the likelihood is highly unlikely that rates are either cut or hiked for 2020, and very good chance in 2021 as well, okay? Supporting this, persistently low inflation throughout the prior economic recovery, right? So the prior economic recovery, we didn't see inflation over 2% until late in 2018, when they actually really started raising rates, and we had that bout of market volatility in December, right? So because of that, we expect a lot of the same, and we do not expect the Fed to really start raising rates until much later in the economic cycle, which is likely more than 1 year away from today. Okay. Last but not least, we're going to wrap it up with the election. I think this is the greatest, the most important piece of this year. Lou's going to talk a little bit about that, but there's one fact in here that I'm not sure if anyone on this call actually really knows, but the stock.
Well, don't steal my thunder.
Yeah, the stock market is the best predictor of the election. So tell them about it, Lou.
Yeah, so this is kind of like a little bit of fun statistic topic, and those of you who know me, I love numbers. So, I know this election year does definitely feel different, and it's definitely a unique year. I mean, with the pandemic, with the recession, the heightened partisanship, the mail-in ballots. I mean, I can go on. Unpredictable president, and actually the oldest presidential candidate ever. I mean, there's so many different things that make it, unique in its own way. Anthony, can you change the slide for me, or did you already? No, not yet. All right. So, wait, hold on. Okay. So do stocks perform better under a Republican Congress or a Democratic Congress? Okay. Well, Congress and president, right? So actually stocks have tended to actually do their best during a split Congress. The markets tend to like more of the checks and balances to make sure one party doesn't have any sway over the other, right? So if we really look at this, the S&P 500 has done around 13.4% under a Republican Congress on average, with the GDP, gross domestic product, doing about 3%, okay? And Democratic Congress, 10.7 with the 3.3 on the GDP growth rate. And on a split Congress, on average, it's done around 17%. So it's pretty interesting that under a split Congress, that's kind of where we do the best. Anthony, you want to switch that for me?
So this is not a political conversation, and we're not talking about what side of the fence we're on.
Okay. So here's what's also interesting, right? So if we look at the stock performance so today's actually day one of the 100 days before the election, or 3 months, right? And so what's interesting to see is like the elections have actually, since 1984, the performance of the stock market has actually projected the winner of every president since 1984, and 87% of the presidents since 1928. So basically, if the stock market is doing well 3 months going into the election, the current president actually wins the election. And if the stock market does bad and starts to perform negatively, in these 3 months, then the existing president tends to lose the election. So, it's just pretty interesting how the stock market, as it's being a forward-looking vehicle, does have that kind of insight. That's it, Anthony. You want to take over there?
And then we got, obviously, for all the compliance people in the room that are checking down on us with Zoom bombing, we have some important disclosures. Obviously, stock markets are forward-looking, and past blah, 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 and that's it. Look, I mean, I know we breeze through a lot of this stuff. I know some of it may be Greek to each and every one of you, but the reality of it is that's what we're here for, right? We're here to just kind of give you some baseline understanding on what we think is going to happen. Whether we talk every week, whether we talk every month, or we don't talk at all, just know that we're doing our due diligence, and we're doing, we're doing our research to understand where we think markets are going to go. And that's what we use as I said before, mile markers, trail markers on how we invest your money and how we keep you safe from completely disrupting your retirement plan. As I said before, I don't know what mile marker I'm going to crash my car, but I do know that what conditions favor an accident over others, right? So if it's tomorrow when we have a, tropical storm hitting, affecting New Jersey, I may drive my car a little bit slower. And that's how we treat your money, and that's how we treat the stock markets. If there are risks out there on the table, we may drive a little bit slower. Okay. If we don't see any risks, we may drive a little bit faster to get you where you need to be a little bit sooner than you actually projected to be. I want to open it up to see if anybody's got any questions. I know it was kind of, we tried to keep it as high level and as simple as and easy to understand as possible. But, we're here to help. We're here for questions. And if there are no questions, then I guess we're going to let you go for an early happy hour. No? Everybody's quiet. Oh, wait, Carol looks like she's got a question. She's got to unmute herself. All right.
Oh, can you hear me now?
I got you. Yep.
Anthony, I want to back up. When you said that the market is forward-looking,
Yes.
how forward-looking is that? So, in other words, if, let's say, everything just stays the way it is for the next 6 months or so, is that going to have a major impact?
So if everything stays the way it is, meaning if there's still 30 million unemployment,
Yeah, exactly.
and businesses are still shut down, So here's what stock markets absolutely hate, right? Stock markets absolutely hate uncertainty, right? So what I could say, so what I could say is this: if things don't change, right, at some point or another, we go back to we go back to that Nike swoosh gradual recovery, right? Right now, we're just in we'll call it the honeymoon phase. The government just gave us free money. I mean, they printed money hand over fist. They call it stimulus, that's the honeymoon phase. That was the snapback, right? Markets get back to the underlying fundamentals, and the underlying fundamentals are transportation activity, jobs, unemployment, right? The economic data that we started off talking about. So if nothing changes, it will create headwinds that make it difficult to allow for the recovery to continue as rapid as it has, right? And that's what and we actually expect that to happen. That's why we think it's going to be a low, slow, and gradual recovery, right? We think that the quick gains that we've seen, we've pretty much seen most of them, right? We may see a few more, bouts of upward momentum, but we expect it to get back to the underlying fundamentals, which is exactly what you have concerns on: unemployment, economic activity, et cetera, et cetera. Will that mean that all of a sudden we have a huge sell-off in the market? No, not necessarily. We don't necessarily think that that's a huge risk, unless we get inflation along with, because of all the money they printed, along with stagnant economic activity. If those two things happen at the same time, then we have some risk on the table. And it's
right. Well, it also
really gauge.
Right, and in addition to that too, it also has to do with the vaccine and the second wave. I mean, a small second wave is priced into the market, but a large, if we really go back to nobody's leaving the house type of thing, I mean, that's not priced into the market. So yes, the market is forward looking, but there are certain things that it's not priced in just yet.
Oh, thanks.
Does that answer your question?
It does. Thank you.
Great. Well, I think that about wraps it up. I think that everybody wants to enjoy an earlier happy hour, I guess, or I should say right at happy hour. But look, we really appreciate it. We've recorded this conversation. It will be, we will have it posted, for future use if you ever want to replay it. And look, we appreciate the time that you take. We're always here to answer any questions. If you need to reach out, by all means, do not hesitate to reach out to us. And look, we're only just a phone call away. We appreciate the support, and we appreciate all the opportunity.
Thank you.
Thank you.
Right,
No
thank
problem.
you.
Thank you very much. Everybody have a great one.
You too.
Take care.